Welcome back to Investing Talk Podcast.
Today we're looking at Rocket Lab.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Rocket Lab. What we're seeing here is a really fascinating inflection point.
Right.
The core story isn't just about a successful small launch provider anymore. Not at all. It's a dramatic evolution.
Right.
Rocket Lab is actively transforming itself into a large-scale, vertically integrated space infrastructure and defense prime contractor. This is a crucial distinction for anyone looking at the stock.
That shift from being like a launch taxi to being a full-service space provider fundamentally changes the risk profile.
The opportunity set.
And the opportunity set, exactly. But we need to see that ambition reflected in the financials.
Yeah.
And the latest numbers, they certainly seem to point to success in that transition.
They really do.
If you look at Q3 of 2025, they delivered revenue of, what, $155 million?
Yeah, and that $155 million wasn't just a marginal beat. It significantly topped consensus expectations and represented, very strong growth, almost 48% year over year.
Wow.
I mean, for a high CapEx, high growth space company, that level of accelerating top line growth is exactly what investors need to see to justify that. Aggressive valuation we'll get into later.
What I find more telling, though, isn't just the headline number, it's the segment mix.
Right.
A few years ago, launch services was the whole show. Now, space systems, which is, manufacturing satellites, components, mission services, that's become the behemoth. It brought in $114.2 million in Q3.
And that's the majority of their revenue now.
Yeah.
That is the critical nugget of knowledge right there. It means the company is successfully moving up the value chain. They are selling the full package, which, generally carries much higher margins than just selling a seat on a rocket.
So it stabilizes things.
It stabilizes the revenue stream and makes the business less cyclical.
Yeah, absolutely. And that strategic shift, it's been massively validated by the defense sector. The biggest catalyst for this entire thesis has to be that recent contract they won from the Space Development Agency, the SDA.
Oh, absolutely foundational. For those who don't know, the SDA is building out these resilient, low Earth orbit constellations for things like missile tracking. This is critical national security work.
And the contract is huge.
It's massive. This single SDA award is worth up to $816 million for 18 satellites. Think about the scale of that. This one contract is almost as large as their entire existing annual revenue run rate. It's a game changer.
And it expands their total backlog, which is now sitting north of, what, $1.1 billion?
That's right.
That figure, $1.1 billion, is impressive, but for growth companies, sometimes that backlog can be a decades-long promise.
That's a great point. But what provides real confidence here is the near-term conversion rate.
Okay.
Management has guided that they expect roughly 57% of that $1.1 billion backlog to convert into actual recognized revenue within the next 12 months.
Within a year.
Within a year. That isn't blue sky potential. That's high certainty revenue already scheduled to hit the books. For defense clients, the monetization timeline is it's much faster and stickier.
Okay, so visibility is great, but cash flow is what matters in the long run. Let's talk about the path to profitability. That means margin expansion.
Right. Is this growth just cheap volume, or is it high-quality revenue?
Exactly.
Well, the margin story is actually accelerating faster than many expected. Their Q3 non-GAAP gross margin hit 41.9%.
And that was above their own guidance, right?
It was, and they're guiding for even better performance into Q4 2025. They're targeting 43% to 45%. This is a fantastic trajectory.
So what's driving that? Is it just the volume of Electron launches finally hitting scale, or is it that favorable segment mix we talked about?
It's both. But the mix is the real lever here. Space systems components, like high-quality satellite buses and internal parts, they just carry superior margins.
So as that becomes a bigger piece of the pie,
it naturally lifts the overall gross margin profile. But they aren't ignoring launch either. Longer term, the target is 45% to 50% gross margin, specifically on their Electron vehicle.
Wow.
If they can achieve that kind of operating leverage on their reusable small-lift rocket, their path to true profitability becomes significantly clearer.
And speaking of execution, they need the financial firepower to get all this done. Does the balance sheet support this aggressive growth plan?
It does. Despite still being pre-profit, they have built a substantial war chest. Rocket Lab ended Q3 2025 with cash and equivalents over $1 billion.
$1 billion.
And what's interesting is that this cash was bolstered by a recent equity raise. And they did it before the massive SDA award was even publicly finalized.
So they were proactive. They secured the funds to execute before the market fully appreciated the scale of the win.
That's how I see it. Having over $1 billion in the bank, alongside $1 billion+ backlog, means they have ample runway to develop Neutron without, the desperate need for more dilutive capital raises.
Okay, and that financial strength leads us to their strategic edge, right? The vertical integration. You call it their moat.
Exactly, because few can replicate it.
Okay, so let's unpack that a bit. When we talk about vertical integration, what are the two main pillars Rocket Lab combines?
They combine launch services, so Electron and soon Neutron, with space systems. That's everything from designing and building the actual satellites to running the mission services once they're in orbit. They control the whole stack.
And why should a customer like the U.S. Space Force care about that? Couldn't they just buy a satellite from one company and a launch from another?
They could, but that introduces risk. Schedule risk. Interface risk. When Rocket Lab owns both, they can offer what the market calls mission as a service.
Right.
This is vital for clients who value schedule reliability above pure minimum cost. Defense clients especially prioritize having a single, reliable point of contact who can guarantee the timeline.
And they have proof points. I remember reading about a U.S. Space Force mission they did recently, and they launched that mission 5 months ahead of schedule.
5 months early. That operational agility is so hard to compete with if you're a fragmented supplier. It builds immense trust, which is really the currency in the defense space.
And that credibility is also built on their workhorse, Electron.
Of course. They did a record 21 Electron launches in FY25. 100% success for the year.
21 launches. That's a high-frequency cadence. What does that break down to?
It's roughly one launch every 17 days. That level of reliability and tempo, it really sets the stage for their biggest growth engine, the one that truly transitions them into a global competitor. Neutron.
Absolutely. Neutron is their reusable medium-lift rocket. It's designed to compete directly with, well, the workhorse of the industry, the Falcon 9 class.
This is the existential step change. This is what transitions the company from a niche player in small lift to a platform competitor across the entire medium lift spectrum.
And this is the ultimate catalyst that everyone is waiting for. The first launch is targeted for Q1 of 2026.
A huge near-term catalyst. If they hit that timeline and successfully demonstrate reusability, that will unlock the next huge leg of institutional investment.
Okay, we spent a lot of time on the bull case. We need to pivot sharply and address the cost side. This is the primary counterpoint, right? The cost of growth.
Can't talk about massive R&D without talking about the capital intensity.
Exactly.
And that cost is significant. They are aggressively investing, which leads to negative free cash flow. In Q3, they reported negative FCF of about $69.4 million. That's a substantial quarterly burn.
It is, but that burn is highly strategic. It's tied directly to building new infrastructure and the massive R&D for Neutron. They've budgeted a cumulative total of around $360 million for the Neutron program through the end of 2025.
So you have to view that negative SCF through the lens of investment.
Exactly. It's an investment into a future asset that fundamentally changes the company's revenue potential.
But investors hate cash burn, regardless. So what's the mitigating factor here? When does it stop? Well, management has offered a clear path forward, which is crucial. They confirmed that Neutron R&D spending is currently at or near its peak.
At or near peak. So we shouldn't expect these massive R&D outlays to continue at this pace indefinitely.
That's the signal. Once they pass that peak, the expenditures should transition from being an R&D expense to being classified as inventory and production costs after, say, Flight 2.
Which is a path toward improved operating leverage.
A much clearer path.
So now we have to address the elephant in the room that ties all of this together. The valuation.
The valuation. Even with all these compelling growth drivers, the stock currently trades at an extreme premium, somewhere around 48 to 50 times forward revenue.
That's lofty territory, especially for a company not yet generating profit. That valuation is essentially pricing in perfection.
It is. That premium multiple requires near flawless execution on two critical fronts. First, they must hit that Neutron timeline Q1 2026. And second, they need to execute flawlessly on the ramp-up of that SDA contract.
If there's a significant schedule pushout or a technical failure,
that premium multiple could be severely challenged. Execution risk is, without a doubt, the main bear case here.
Despite that, the market momentum is currently overpowering those concerns. I mean, technically, the stock has been in a powerful uptrend, soaring roughly 182% just in 2025.
That kind of performance doesn't happen without structural institutional support.
Hmm.
And from a technical analysis perspective, we're watching the 70 to 72 $2 region very closely.
The old resistance becomes new support.
Exactly. If it pulls back to that level and holds, it would confirm the underlying bullish trend.
Okay, before we wrap up, we need to address something that often raises questions, which is the insider selling. We saw a significant total, around $152 million over a 90-day period.
Including a major sale by the CEO of roughly $90 million.
Right, and when you see numbers like that, it's natural to think management is dumping the stock.
It is, but context is everything here. These sales were largely executed via what are called Rule 10b5-1 plans.
Can you just quickly define that?
Sure. A 10b5-1 plan is a pre-scheduled trading plan that insiders set up months in advance. The key is that the selling decision is locked in when the insider is not in possession of any material non-public information.
So it's not a reaction to bad news, it's pre-scheduled profit-taking.
Exactly. It's seen as routine profit-taking after multi-100% gains. And the fact that the demand has been strong enough to absorb that massive supply, $152 million, without breaking the uptrend.
That's a major technical signal in
A
itself.
huge one. It suggests that institutional accumulation is actively absorbing the profit-taking from those early investors.
So, to summarize the investment thesis here, Rocket Lab is no longer a small niche player. It is rapidly positioning itself as the strategic, vertically integrated U.S. alternative to SpaceX.
That's the core of it. The immediate drivers are that massive validation from the defense sector via the SEA contract and the major technological step-up coming with Neutron, targeted for Q1 2026.
And this is definitely not a stock for a quick trade. The primary horizon here seems to be a multi-year hold, right? Maybe 3 to 5 years, to really see the monetization of those contracts and the full commercial ramp-up of Neutron.
I think so. That's when the operating leverage truly kicks in and could potentially validate that high premium. And that leads to the final provocative thought for you to consider.
Okay.
If Neutron successfully demonstrates full reusability and reliable medium-lift performance, how quickly could it become the preferred complementary launcher for those massive low Earth orbit constellation customers?
So a dual sourcing option.
Exactly. Right now, many are tied to one provider, but every large company in the world looks to diversify their supply chain risk.
Yeah.
The potential for Rocket Lab to become that required alternative is, I think, the true upside optionality here.
That's a great thought to leave you with. If you found this discussion helpful and want more analysis into the companies driving the market, make sure you subscribe. We'll be back soon.